We are just sifting through everything that we're seeing in this Truth Social post, but two major developments. He is authorizing a 90-day pause and substantially lowering the reciprocal tariff during this period of 10% effective immediately. There's some fuzzy language here. The upshot is that there's a 90-day pause in the reciprocal tariff. What I'm not clear on is whether we go to zero during that time or to back where we were, or if the 10% tariff remains in place. Either way, a major step forward. The president says that this is because more than 75 countries have called representatives of the United States. Negotiations are ongoing, and so he's instituting this 90-day pause in the meantime. On the other hand, some negative news on China, saying that based on the lack of respect that China has shown to the world's markets, he's raising the tariff on China to 125%. That's, of course, up from the 104% that took effect just at midnight, now going even higher to 125% because he does not like the way China has been retaliating rather than coming to the United States and wanting to negotiate. So two major step forwards here. One, obviously, very good for the markets. You're seeing the markets react to that. The other one on China, looking like, they don't like the lack of respect that they see. So we are looking at a world in which things continue to get worse with China, one of our largest trading partners, but of course not the largest, but getting much better with everybody else, at least temporarily, while these negotiations, Kelly, are ongoing.
Before we get into the global bullion bull market details for this week, I want to remind you of some of the stark investor drawdowns suffered last century when governments got into trade wars that often led to world wars, or while suffering for often decades under massively inflationary economic regimes. Investor drawdowns from nearly negative 50% to negative 100%, depending on the region and eras. Only but a few of those investing catastrophes have people still alive today that actually suffered through them and can tell you firsthand. Some elderly Chinese and Japanese and older Indians and French could speak to this kind of horrid investor climate. For the most part, to learn this kind of information, you have to actually read some financial history books and look at the roadkill. The good news is, one of the high net worth investor class can speak to it, and although he's a somewhat bumbling public speaker, Ray Dalio went on CNBC and Bloomberg this week to try and remind everyone of the tectonic forces at play in our changing world today.
We're seeing a classic breakdown of the major monetary, political, and geopolitical orders. This sort of breakdown occurs only about once in a lifetime, but they have happened many times in history when similar unsustainable conditions were in place. Joining us right now, first on CNBC, is Bridgewater founder Ray Dalio, and we're thrilled to have you here on a morning when we're still trying to make sense of what all these tariffs mean, Ray, and frankly, how all of this plays out. So to the extent that you can help us with the history, or at least a history lesson, if you think there are parallels, how does this play out?
I think that we don't understand how the cycle goes because it comes along about once a lifetime. But there are orders, there are systems, and the systems break down for certain reasons, and it creates cycles. For example, there's a monetary system, and then there's a debt cycle. And so as a result, we now have one man's debts, another man's assets. And when you build these up and you get to a point where you can't sustain that, you have a debt issue. We have a debt issue. We can get into that. But there's a monetary cycle. There's a internal political order cycle that takes us from one political order to another political order, in which there's then classically great turbulence between the left and the right. And because of disorder, particularly in democracies, there's a lot of fighting because there needs to be cooperation, compromise, and so on. And we're in the process of changing that order. In addition, we have the international world order. International world order began in 1945. There's a war. You win a war. The dominant powers get to set the rules. That was a series of multilateralism, things like the United Nations, World Trade Organization, World This and World That. And that multilateralism is then breaking down for unilateralism for the same reasons. So there are these three orders related to too much debt. Debt is money. Second, internal order. How does our system work? Who's going to get control of this? problem. And then number three, in addition of the five main forces, there's also throughout history climate, acts of nature. Droughts, floods, and pandemics have killed more people and toppled more orders. And then there's also throughout history, man's inventiveness and new technologies, which is creating this transformative result.
Right.
The interactions of these is what's going on. So if we look at tariffs represent a dealing with the imbalances. The imbalance means we have a tremendous capital imbalance and a tremendous trade imbalance, which is unsustainable. And so that's the backdrop of this. Related to that is also the international conflict. How do you have dependency, mutual dependency? How can the United States be a safe country and not manufacture things and have to import them for China? Or how can China be safe in terms of having capital, an American capital? Those connections are breaking down. So that's the essence of the backtrack.
Someone said to me last week, this is like a wealth tax, except that nobody gets the money. In that, 10% of a lot of folks' wealth vanished overnight as a function of at least this discussion thus far. So what happens?
Well, mechanistically, it raises costs. It lowers revenues for companies. I mean, what does it mean for a company? And capital is going to be harder to come by. And then we're trying to replace manufacturing. I mean, I agree with the problems, okay, about the fact that we don't manufacture and that there is a problem with that. But there's a structural problem of whether we can manufacture. We have a population that basically 3 million people, 1% of the population, is incredibly brilliant. I mean, they go to the best schools, they come out, they make the unicorns, inventiveness, half of which, by the way, are foreigners. And at the same time, they are making the unicorns. At the same time, what we have is 10% of the population around them that's doing very well. The 60% of the population has below a sixth grade reading level.
Okay, so let's put that statement that more than half of the U.S. population, or around 54%, read below a sixth grade level. And also that about 21% of them are considered illiterate. So let's check in on our spending habits ongoing. The U.S. fiscal year 2025 is now half over, and the latest deficit update from the U.S. Treasury is out. Total deficit year-to-date is negative $1.3 trillion. That's up 22.8% from fiscal year 2024 at the halfway point compared. Now, all the Doge headlines aside, the U.S. government's overspending deficit is on track to exceed $2 trillion for this fiscal year 2025. Back to Ray Dalio.
We have to get the budget deficit down to 3% of GDP. I worry about that at the same time as this is happening. These are not easy problems to solve, I'm concerned, because the bigger problems exist. The debt exists. You can't get around the debt. The overspending exists. You still have that. You still have that competitiveness issue. These have repeated throughout history. We're in a period that's very much like the 1930s.
Here's a look at some of the excellent investor returns of the 1930s. In other words, the Great Depression taking wasn't just a USA phenomenon, it was worldwide. And while overpaid CNBC talking heads are griping about negative 10% drawdowns on paper, let me remind you that measured by gold, historically speaking, we are still at nosebleed levels higher than the 1929 top. Both that bubble and the Nifty 50 stock market bubble enjoyed decades that followed of gold outperforming U.S. stocks. And of course, the silver side of this relative silver bullion versus U.S. stocks valuation equation, it's even more ridiculous at the moment. Now, I can go even further back in time using the Dow divided by gold over more than 2 centuries of U.S. financial history and take a close look at what is melting below the general green channel higher. That's gold on a relative basis, beating the 30 largest rotating cherry-picked bubble stocks in the USA. Now, the last time gold broke this channel to the downside, that was the 2011 lows. Repeating that would mean gold would outperform the Dow by a factor of more than 2 to down there. But get even more extreme than that, and we're looking at the late 1970s and January 1980 low, which suggests potential outperformance of gold over U.S. stocks by a factor of tenfold in the Dow. Well, I know it all sounds extreme, but gold is simply doing what it has always done from time to time: reaccount and put financial bubbles back into their place by a relative reaccounting of gold outperforming them all. Now, the older aged gold bullion bull calls for gold at 5,000, it doesn't sound so crazy now, does it? For the past few days, gold market onlookers have been spellbound by spot gold price moves of $100 an ounce per day within 24-hour periods. Now, while nominally that sounds like a lot, allow me to remind you that on a percentage basis, the recent price volatility we've been seeing in gold is less than half the daily price percentage moves that we saw during the 2008 global financial crisis. Now, the silver side of this equation during the 2008 GFC was literally a place where market-levered amateurs and short bank desks would go to die inside. Something that would make even degenerate crypto rug-pulling crowd think twice about playing inside levered up on a short-term basis. Now, why was there so much volatility and wild price swings in the 2008 GFC? Well, let's think here. We had banks collapsing, deflation, lack of funding for margin calls, and flat-out recession. Now, speaking of the latter, Ray Dalio and others also took to Bloomberg this week to hit listeners over the head with the R word.
I think it's likely that we're going to be in a recession. And the question really, recession is, a line at zero you get, and then, sort of 2 quarters in that. And I think right now it's close call and it's probable.
We have to make some difficult choices. We might have to go through a brief recession in order to rebuild our foundation.
If we do get a proper recession, the S&P likely bottoms at about 4,600, 4,700. We didn't get to that level. I think a deep recession is off the table for now if we can stick at this 10% tariff rate.
I think I've already moved to recession with a capital R. I think it's going to be deeper. I think the friction that's going on globally is going to cause a global recession, and we're not going to be spared.
I'm more worried about the greater dynamic of these conflicts. I'm worried about more serious issues
that are structural,
the financial,
and hard
the
to fix.
political, the financial, the political, and the geopolitical, because they feed on itself if you get a bad one.
Right. Thank you so much for your time today.
I think that this is not a normal recession kind of situation. We are changing the monetary order. In other words, when we start to think there's supply and the demand for debt, and one man's debts are another man's assets, as I said. And then the question is, money, which is debt, is supposed to be both a medium of exchange and a storehold of wealth. And there are times in history, and this is one of those times in history, that there's a question of whether bonds are an effective storehold of wealth because of this supply, demand, and so on.
No, we're not going to let Ray Dalio get away with saying something as fallacious as debt is money. As a matter of fact, debt goes through long durations of not storing wealth all that well. This image, taken in 1972, might remind you of the last terrible bond market era preceding the 1980s fiat financialization. The rampant price inflation we have collectively suffered under ever since, basically silver and gold and sound money ties were cut, is leaving us with poor, not value storing units of overcreated fiat currency supplies galore. Let's at least let Mr. Dalio get off one more line from way back in 2012 when he sucked the air right out of the Council on Foreign Relations room as he had the audacity to mention the word gold in public.
There's no sensible reason not to have some, if you're going to own a currency, if you don't, it's not sensible not to own gold. Now, it depends on the amount of gold. But if you don't own, I don't know, 10% if you don't have that, and then depends on the world, then there's no sensible reason other than you don't know history and you don't know the economics of it. But cash. So cash, it's an alternative. View it in terms of an alternative form of cash, and also view it as a hedge against what the other parts of your portfolio are, because there's traditional financial assets. And so in that context, as a diversifier, as a source of that, there should be a piece of that in gold, is all I'm saying.
Okay.
The truth about bullion allocation backtesting models going all the way back to when London gold pool price rigging scheme failed in 1968 is that typical households and central bank balance sheets need well more than a mere 10% of bullion allocations with their liquid net worth. When compared to the S&P 500 and the U.S. bonds and bill market, the best risk-reward number typically comes in at like 27 to 30% gold bullion allocations over the last 57 years of time and financial data. Central banks know this, and they've been front-running the trade, bullion over bonds, in record tonnage buying for years now. I know they're not the only ones. All you billionaires out there are getting yours, and you probably front-run them. Now stick around on the other side of this break. We're going to look at how brittle the underlying trading contracts truly are in the COMEX gold and silver futures market trade, and my contention that another frenetic levered long upside price movement era for gold, silver, and precious metals related is not long away.
Hello, this is James Anderson on behalf of SD Bullion. Smash the like button if you enjoy these bullion market updates.
And be sure to visit sdbullion.com/sweepstakes to enter our free 500-ounce silver coin giveaway.
Traditionally, you got your dealer, your custodian, your depository.
The reason why ours is so good, first of all, we're two of those three parties, right? We have the depository, we're the retailer. The only thing we're not is the custodian. We don't get any negative experience from the customer because of how fast things are going. Who you pick is incredibly important. SD Bullion, we're different.
The gold spot price popped to new nominal record high close this week on the 90-day tariff delay news. It closed this week at $3,250 an ounce ask price. The silver spot price got moving back higher, but a bit slower than gold. It closed this week at $32.45 an ounce ask price. The spot gold silver ratio is still at the century mark, a complete rare height in undervaluation versus gold on a historic basis. Is this the high as far as the spot gold silver ratio? That I don't know. What I do know is bailout queens and crony fake capitalists were out there this week banging the drum to begin a new era of infinite QE to deter those crumbling markets from collapsing in on themselves. We had bug-eyed Kashkari, Rico Des Suave's CEO, all banging the table to start slamming digital US dollar keystrokes on the keyboard. Seems it's again time to dust off the old bailout blueprints under the threat that if we don't do that, we're going back to living in caves. Let me remind you the first time they did this looting of the U.S. Treasury in broad daylight back during the late 2008 after the then spot GSR had ballooned to near 88 in October of 2008, only to have silver go on a tear to down just below 30 on the spot GSR in about 2.5 year time frame that followed. So yeah, almost a threefold factor of outperformance. And yes, I know the bullion bull market price climbs on the wall of worry are not as jagged as their bear market falls, especially with criminal bank desks bonusing off the situation for years. But I'm going to mirror this chart on the other side and remind you that there is serious price volatility to come by simply mirroring the 2011-2012 falls in silver price and pasting it onto the future, looking out as an example of the volatility we suffered through and that you're going to probably see in the future. And yes, as time proceeds, it will become more common knowledge that both silver and gold have been systemically valuation suppressed for long spells of time. I'm talking decades. Decoupling aggregate daily gold and silver price data makes that clear and obvious to anyone who dares look. Meanwhile, the underlying gold futures contracts on the COMEX are now half comprised of smaller 10-ounce micro gold futures contracts, illustrating that gold is becoming so expensive on a nominal basis that even for the over-leveraged degenerates in that casino, they require tiny contracts and will likely continue to do so as time proceeds. A similar story on the underlying silver futures contracts of the COMEX. Now about 1/4 are comprised of smaller 1,000-ounce mini silver futures contracts, illustrating tinier fish swimming in those shark-infested casinos. Yet the silver price in Switzerland still needs to triple just to reach its old 1980 nominal high, in much stronger purchasing power fiat Swiss francs back then. Yes, Switzerland, we are all impressed by your gold refining. But what is even more impressive is how many of you balk at silver bullion at these suppressed valuations because of some silly 8.1% VAT, which can be wiped out in a good week like this one for silver. Prepare yourselves. The gold establishment and half-wit no financial media will begin flashing CPI-rigged gold price charts showing you that the old 1980 high was about $3,685 an ounce in today's debased dollars. But the actual truth is probably closer to adding a zero on that number, given that the world's biggest debtor produced those figures, and they're going to lie to you straight to your face over and over again. Ready yourselves for more dumbed-down articles and media coverage where they're going to pitch you on unsecured ETFs, where you get to own nothing and are happy to pay for the price risk that you get. Or some hole in the ground, where God knows where, under whose jurisdiction, that has likely underperformed bullion on the regular since all the way back to the year 2007. And here I will remind you again the comeuppance that occurred the last time the U.S. Treasury in London conspired to rig gold and silver prices. It basically started in 1975 on the gold side, and it continued to the late summer 1976, effectively cutting the then gold spot price in half, from 200 to about 100, by injecting mass derivative leverage via the casino on the COMEX into day-to-day price discovery. What followed was a more than 8x in gold prices and an over 12x move for silver in about 3.5 years. Now, to close, we're going to have a little fun with a shout out to the Silver Squeeze chat room on Twitter X. Been hanging out with the fellas there for the last few weeks. We are there to get the word out about silver and raise the collective consciousness about the benefits of owning it outright now, not later. You'd probably be shocked about the size of the silver bulls who have shown up and regularly engage. We even got some fun memorabilia and, of course, memers galore. So let's outro with a few highs and lowlights from last week. Thanks for coming through, you all out there. That will be all for this week's SD Bullion Market Update. And as always, take great care of yourselves and those you love. If you enjoyed this video, hit the like button and share it with those you love. Subscribe to our channel and hit that alert button so you know when we publish new bullion market updates.